Officially, the end of the tax year is the 5th of April, but you always need to consider your income for the full tax year, so from the prior 6th of April to the 5th of April. And that's when you probably need to consider a number of things, such as how much income have you taken so far and how will you be taxed on that? Are there still any unused allowances that you need to make use of? And also thinking about future tax years. Do you need to make any changes on how you take any income? Any changes in tax rates or allowances? So as we approach the end of the tax year, it's just a really good time to get your ducks in a row. The most asked question is, can I take any more dividends? And the answer is normally yes. But there are some things to consider before doing so. Is it actually tax efficient to do so? And is there enough profit before you take that dividend? The key thing is always noting that corporation tax is payable first, and any profits thereafter are then what is available to the shareholders of the company. Unless your company year-end matches the tax year, the company year-end is the most important when considering what expenses you need to put through in order to reduce your profits and therefore get corporation tax relief. There are still some expenses that you do need to consider in regards to the tax year, such as making sure that you've maximised the trivial benefits as a company director. The key thing with expenses is actually making sure that from a company point of view, you've kept all your business records to date. Otherwise, HMRC can charge a penalty of up to £3,000 for failure to keep those records. So from April 2023, the dividend allowance dropped from £2,000 to £1,000. However, the rest of the rates remained the same. 8.75 for dividends in the basic rate band, 33.75 for dividends in the higher rate, and 39.35 for any dividends on the additional rate. So typically for most people that have used up their personal allowance and then are taking dividends to maximise the basic rate band, they're looking at a tax liability of around £3,200. However, the one thing that does sting our clients every now and again is also HMRC may require you to make payments on account. If your tax bill is over £1,000 and less than 20% of that was taxed at source, then HMRC will ask for 50% in addition to when you make your balancing payment in January, plus they'll also ask for another 50% in July as well. So as the tax year ends shortly, we'll be also sending questionnaires to our clients. So for those clients that are really keen to understand their tax liabilities, the sooner they return the questionnaire, the sooner we can prepare the draft return so they can make sure they've got the funds ready to pay their bill. So if you're looking to maximise your ISA this year for savings, the current allowance is £20,000. It's a great way for you to put money into a savings account because any interest from it is not taxable. Your spouse will also get the same allowance of £20,000, and there's also the availability to have a junior ISA of up to £9,000 as well. But it is important to remember that any contributions into an ISA must be made from personal funds, and also sadly, if you don't utilise those allowances, they won't then get carried forward to the next year. There are two ways in which you can contribute into your pension pot, either as an individual, which would be an employee contribution, or you can make an employer contribution directly from your limited company. And that gives you greater flexibility on the amount that you wish to contribute. Now, personal contributions will mean that you'll get tax relief through the self-assessment tax return, and this can help with reducing overall taxable income for the year. Whereas employer contributions through your company would be treated like any other expense. Plus, you may find that there are other opportunities for pension contributions for other employees or your spouse. The maximum contributions that you can make into your pot, both from employee and employer contributions, is currently £60,000 this year. But if you haven't maximised your pension in the last 3 years, then there is again an opportunity to use your carry forward allowances. So it could mean that in total, you could actually put £180,000 into your pension pot. But before you do so, I definitely suggest checking with a financial advisor first. There's so many things to consider as we approach the end of the tax year, and you'll always need to consider your individual circumstances. It might be that you've got a large tax bill to pay and some surplus funds that you're looking to invest. So you could consider EIS, SEIS or VCTs because you'll then get the tax relief in the year of the investment. It might be that you need to consider child benefit. If you or your partner's income exceeds $50,000, the highest earner will need to declare the child benefit on the tax return and have that reclawed. It could be that your personal income is already over $100,000 and therefore you're starting to lose your personal allowance, so you may wish to consider pension contributions. There are other allowances, like capital gains. Have you used up the full £6,000 for the exemption this year? Or have you and your partner used the full personal allowance? And if not, have you claimed marriage allowance? There are so many things to consider as the tax year comes to an end, and each person's circumstances will be individual to them, so it's always best to get advice where possible.